Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 13th of March. I'm Daniel Lam, your host for the podcast. The February US CPI came in cooler than expected. Headline inflation decelerated to 2.8% year over year, as did core, which now stands at 3.1% year over year. Core services inflation declined, while core goods inflation was roughly unchanged. Now, inflation seems to be heading towards the Fed's target, but we need to note a few factors. So first of all, services inflation is slow moving and reflects labor market tightness. Secondly, goods inflation tends to be faster moving and is driven by commodities and import prices. And lastly, core services inflation is moderating, but it remains above pre-COVID levels. So this actually leaves overall inflation vulnerable to a rebound if goods prices start to rise again. Now, goods prices are vulnerable to the narrative in tariffs, and the inflationary effect from tariffs will prevent the Fed from easing. So there's a tug-of-war dynamics going on, and it shows up in the market reaction as well. So S&P 500 started last night strong, down to the day's low, before recovering to the middle of the intraday range and small up close on close. But note that the S&P 500 is holding up relatively well, just under the 5,600 level, the area where we indicated as Trump's first pain point. And the next key support is at 5,403. Now, more interestingly, if you dig deeper, we started to notice a pickup in volume buying for the Magnificent Seven stocks. Now, usually after a correction, as market attempts to bottom out, there will be bargain hunters for the key bellwether stocks, i.e., these stocks would be the ones that would, quote-unquote, take the lead, followed by the smaller and second-tier stocks. So we are seeing some encouraging signs developing in the US equities markets. There's also a case to be built for money flowing back into US equities. So if you look at the bond space, the US 10-year government bond yield is building double bottom around the 4.1% level, after dropping by more than 50 basis points since the middle of February. Now, from the equity space, if you look at the major equity markets outside the US, they probably have seen their best days in the short term. So for example, the Hang Seng Index is struggling to break higher after the impetus from DeepSeek. Reality is sinking in once again in the form of poor economic data, such as the latest Chinese CPI. Now, Europe has priced in, to a large extent, the news of fiscal stimulus and the potential ceasefire between Russia and Ukraine. So for the long-term investors, it is a reasonable time to start adding to US equities, particularly in the mega-cap stocks or in areas such as software and communication services. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.